Welcome to the Aviation Insurance Podcast, the podcast that helps aircraft owners and aviation businesses learn and understand the complex world of aviation insurance and risk management. From the basic principles of aviation insurance to risk management techniques and updates on the aviation insurance market, the Aviation Insurance Podcast is your guide to traverse the world of aviation insurance. Now, here's your host, Tim Bonnell.
Well, welcome back to the Aviation Insurance Podcast, where we've been talking about the fundamentals of aviation insurance, especially through the lens of an aircraft insurance policy and an aviation commercial general liability policy, and then all those different things we can do to address some of the exclusions that are in those policies. And I want to talk a little bit about something today, slightly different, but will help with gaining some context and understanding a situation that can happen to address some different types of exposures, in particular large insured amounts and large liability limits. That can apply to aircraft or to aviation commercial general liability, but oftentimes the limit is so high that the carrier wants to spread their risk, and that's really the business of insuring risks, is often spreading our risks so that we diversify our exposures by utilizing reinsurance. We are also able to take on a larger capacity and protect against catastrophes and those type of things. So again, reinsurance is insurance for insurance companies. We've talked about that in the past. It's something they do generally in a treaty where they have an agreement to share a portion of the premium and exposure in order to diversify that risk. And also it can be done on a one-on-one basis, on a facultative reinsurance basis to share risks on a particular account or particular exposure. Well, one of the ways that an insurance company will spread risk is also called pooling, right? So a couple of our United States aviation insurance companies are pooling companies. In fact, the first two, United States Aviation Insurance Group, USAIG, which was the first U.S. entrance into the aviation insurance market in 1928, and the second, Associated Aviation Underwriters, which entered the market the next year at 29. They're now a part of Global Aerospace. We're pooling companies. It meant they took several companies who shared the risks of the one policy together. So that concept has emerged over time, especially when we got into jumbo jets, larger seats, larger hull values, where insurance companies, even with reinsurance, only wanted to take on a certain percentage of the risk. And so through these larger exposures, the quota share concept has been utilized and is still utilized to this day. And in fact, in the current market, it's being utilized for risks that it wasn't being utilized for several years ago. Again, higher liability limits with higher risks type of MROs, large liability limits for large airports, airlines. But we're also seeing it in the single pilot jet market, with most carriers requiring a quota share placement with the jets that have a higher than $5 million insured value. So what happens in a quota share is that companies share a percentage of the risk based on what they establish up front. So for instance, just for simple numbers, we're looking to obtain a $100 million limit of liability on a commercial general liability policy. And for simple math, given that's what I need, we're just going to say that, we find a carrier who's willing to lead the policy, meaning they'll set the general terms and issue the leading policy, but they're only going to accept 50% of that risk. They're saying the most we can write on this is $50 million. So then the broker has to go and find one or two or three, how many other carriers it takes to get the other $50 million in the following lines to finish the placement of 100% of that policy. So this is done a little bit differently in the United States versus London, where in the United States, there's actually the lead policy and then a number of following separate policies with separate policy numbers. In London, they typically will have a slip where all of the carriers sign on their information and their percentage on one document. But anyway, it's the concept of coming together and the aviation insurance broker agent finding multiple insurance companies to spread the risk, quota share. Typically, the following markets can't take a larger line than the lead market, and then they will establish a claims handling agreement that the lead will put out there, so that in the event of a claim, being that there's multiple insurance carriers, the claims process will be identified and how to collect the funds for the entirety of the loss based on the percentage. But quota share really means the percentage. We're sharing a percentage. It could be two carriers taking 50% of a risk on a business jet. It could be 10 carriers sharing a limit on an aviation commercial general liability policy with products exposure. It could be 20, 25 carriers taking on a large airline, taking especially small lines. So quota share is a method of spreading the risk on an individual account through multiple insurers in order to accommodate those higher exposures, those larger liability limits, the larger seating capacities of aircraft like the 747 and the A380 and really any wide body jet. And it enables the carriers to spread their risks, to obviously to diversify what they're doing and to prevent major catastrophes. So if you hear the term quota share or this account's going to be placed quota share, even a business jet at a $5 million insured amount, that's what it is. It's a broker having to find more than one insurance company to complete the required insured amount or liability limit in order to have the limits and coverages that the insured or the aviation operation needs. So that's a little bit about spreading risk and how it's done differently. We've talked again about the ongoing, the reinsurance that happens behind the scenes. And then we've talked about insurance companies forming in a way that they're pooling and sharing the risks. And then we have this quota share, which is used a lot today on larger limits, larger values, and more significant exposures. So that is quota share. It helps you understand a little bit more about some of those placements for aviation insurance. Well, that's all for this episode. Join us again next time as we continue navigating the waypoints in aviation insurance. Until then, enjoy clear skies and unlimited visibility.
Thanks for listening to the Aviation Insurance Podcast. If you found this episode of value, please share it with someone who would benefit from this information. Don't forget to subscribe in your podcast player so you don't miss any new episodes, and to help our show have more impact. This episode is brought to you by Aeris Insurance Solutions, your flight plan for navigating the turbulence of aviation insurance. For more information, visit aerosinsurance.com. That is www.aerisinsurance.com. Disclaimer: these episodes are for educational purposes only, and due to the changing regulatory and legal nature of the business, some information may change over time. Having a well-educated and experienced aviation insurance broker on your team is an absolute requirement to success in business and for managing your aircraft and aviation business risks.